Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Victoria Bills, Chief Investment Strategist at Banrion Capital Management, to discuss alternative markets in the NFT space and VC funding environment. Victoria, it's great to have you with us. Welcome to TradeTalks.
Thanks for having me, Jill. Super excited today.
You got it. Sotheby's has launched a peer-to-peer NFT marketplace on Ethereum and Polygon. We know brands like Adidas are leveraging the NFT and alt markets. Is this lending more legitimacy to the sale of NFTs?
So I believe that this is lending a little bit more legitimacy to the sales and marketplace idea of NFTs. What we recently saw is that Sotheby's actually opened a secondaries NFT market in the metaverse, where we had a trade vault where they had a whopping auction of a couple of NFTs for over $2 million, which was unprecedented at the time, and one of the largest sales of like an NFT marketplace at that time. So as we continue to see further adoption of NFTs, and especially more larger organizations getting involved in the secondaries market and in the sale and creation of NFTs, it's going to continue to lend more credence to NFTs as a product as we continue forward.
Does this attract an important investor audience to alternatives?
So I believe that NFTs is very attractive to Gen Z, Zennial, and Millennial populations. We see this as very much an alternative new form of artwork. This goes back to I would say, deviant art days of like my generation, millennials. And so to be able to legitimize, or even to be able to profitize off of the art that you create, or even having an opportunity to be able to sell and trade and track ownership of your artwork or of NFT products helps to kind of lead again a little bit more credence to, and also helping to open up the NFT space for a much younger audience. Now, adoption when it comes to a much older generation, I think is going to come with time and with an understanding, and again, like more of a legitimacy around, is this truly considered art, or is this more of just kind of like a marketplace where we can continue to kind of trade these sorts of ideas? So the actual value that is driven in these NFTs is very much focused on the peer-to-peer sale. Like, I say that this is an amazing opportunity or amazing product, but how much is that actually worth in the large scheme of things is something that we will only see with time.
Right. Well, it's so interesting too, because it always comes back to supply and demand. You can make the same argument with baseball cards. You're assigning a value to a piece of paper, just like you're assigning a value to an NFT, which is a piece of digital artwork. It really is very arbitrary. How can you measure the value for a buyer and a seller on a product that's uniquely yours? How do you determine what that value is?
And that's a very great question. The value essentially is, again, it's driven very much by marketplace. And when we're talking about, for example, the Adidas NFT that they released, it's an NFT that grows or is kind of personalized to that individual person. So if I were interested in selling that NFT, it's essentially, the question around it would be, what is that value of that NFT, not only to myself, but also to the individuals on the secondaries? And we've seen time and time again with these NFT projects that there is a huge boom, a huge interest and demand in the initial phase, but it eventually kind of fizzles out over time. And so as the long-term hold value or long-term sell value for these NFTs is yet to be seen, but I do believe that there is a case to be made for not only the underlying blockchain technology, but also for essentially, as we continue to develop and as new players or more established players in the art space get involved in this, I think we will continue to see, more of a higher demand for these NFTs.
Let's talk about the VC environment more holistically. Do you agree with S&P Global's assessment that investors will rotate away from B2C and into B2B? Is there a bigger play there?
So the way that so when we're looking at the S&P Global assessment on venture capital dollars and how that's traveling across the market, one thing that we have to consider is that most of the fund strategy plays a role in how venture capitalists invest. So if I'm a venture capitalist, for example, that is in the B2C space, I'm not going to change my strategy to be into B2B. And so what are established players and what are established strategies are already pinned into the market. As we continue to see new players coming in, I believe that there is going to be a continued push towards more of that B2B, especially given the SaaS-based revenue that comes out of some B2B play, the market certainty that can come with just having more, I would say, sticky revenue processes. With B2C, there's a lot of marketing that goes into getting a product out. Go-to-market strategy is heavily focused on creating that traction and heavily focused on like creating that market spend and that traction very early on. So that way you can make yourself a distinguished player in that space. So B2B, I believe, has always been more of a safer play if you're thinking about long-term revenue retention, or if you're thinking about, again, like how to actually like penetrate more of those like business to business sales. It's a lot, the sales cycle is longer, but it's stickier than with consumers who can be a little bit more finicky.
Right. And we've been hearing, especially that we've been reporting on Trade Talks, that fintech is really ripe for some of these transactions to take place. What types of companies or subsets in fintech do you see VC support shifting to?
I've seen a lot of VC support actually shifting into payments, but also any system that helps to democratize assets or accessibility to certain financial markets or strategies. So if we're thinking about, for example, the idea, some insurance companies that are making it easier for you to file claims and lower your premiums, it's exploiting the how do I say, the logistical issues that come with the traditional insurance market and how they underwrite some of the underlying insurance issues and products. And so we're finding that some insurance companies are able to use AI and machine learning to basically make the underwriting process a lot more effective and faster, more transparent. And so older systems, whether you're thinking about incident insurance companies, or if you're thinking about larger insurance players that have been around for decades, they're not using these newer technologies. They're still continuing to the old traditional ways of underwriting. And so they're finding that they're losing out on that premium opportunity. And customers themselves are loving these new companies that are coming in, because this is a way for them to not only decrease their overall cost, but still be able to retain a product that essentially is the same value. I'm also seeing a lot of opportunity in trade space, or companies that are allowing for, again, the democratization, whether you're looking at NFTs or if you're looking at democratization of alternative asset products. So the idea of like crowdfunding a venture capital fund, or being able to being able to invest in a venture-backed company as like a small-time investor. That's something that a lot of, I would say, younger generations are looking at, and a lot of VCs are kind of turning their heads towards, because it is a way, not only it benefits them to continue their fundraising efforts, but it also shows a continued interest and effort in these markets.
And finally, Victoria, do you think VC funding has hit the bottom?
I don't believe that VC funding has hit the bottom. I believe that venture capitalists are going to struggle in the next coming year to 2 years when it comes to finding institutional LPs or finding funding, because many of the institutional LPs that we're seeing today, especially given the high interest rate environment and cost of capital increasing, are pulling back in terms of venture capital fund and pulling back in terms of investing in venture funds. That largely has to also do with the fact that these larger funds, if you think about the Sequoias of the world, or A16Z, these firms have they're established players. They have much like billion-dollar funds, but have very much seen a slowdown in their exits. So they're not necessarily making money for the investors off of the exits, but they're continuing to profit off of the management fees. And so if you're looking at if you're an institutional investor and you're thinking about where do I want to place my dollars and how can I continue to retain capital at a much faster rate, you're going to look for opportunities that are in bonds, stocks, or opportunities that are going to be slightly more liquid versus the lockup periods that we have in VC. So where I see opportunity continue to happen is in the early stages of venture capital funding. So thinking about small time pre-seed or seed stage funds. And I believe that, again, as we continue to see investors looking to shift away from these much larger houses in venture capital, we'll see some of that funding, I think, cycle back into smaller time funds, which again, some may consider that to be more risky, but I think that these opportunities that are in like small cap, more or less, is going to provide investors with more opportunities to invest like in the very early stages and help them to get a return on their capital a lot faster than the later stage companies.
All right, appreciate the insight. Thanks for joining us on Trade Talks, Victoria, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.